Did you know that even a small difference in education loan interest rates can save or cost you lakhs of rupees over the years? But how do you pick the best education loan? With so many complicated terms, different interest rates, loan types, hidden fees, and many more. Which one suits you the best? Banks, NBFCs, or the government schemes? Don't worry, I've got you covered. Hi everyone, I am Simran, co-founder at Epicred and your trusted guide to the education loan. We help students like you to secure the best education loan deals with full clarity. In this video, I'll explain you all the key loan terms that you must know, things like principal amount, interest rates, repayment tenure, collateral, processing fees, and much more. You'll also learn how banks, NBFCs, and government loan schemes differ and how to make the best choice. So stay with me till the end to avoid costly mistakes. So now let's break down all the key terms of an education loan. The first thing to understand is the principal amount. This is the total money that you borrow from the lender. Let's say if your education loan costs 30 lakh and you take a loan of 25 lakhs, then 25 lakh is the principal amount. But remember, you don't just repay this amount, you also pay the interest on it. Next is the interest rate. Interest is the extra cost of borrowing money. It is charged as a percentage of the principal amount. Some loans have a fixed interest rate which stays the same throughout, while others have a floating interest rate which can go up or down based on the market conditions. The lower interest rates mean lower EMI, so always compare different lenders before deciding. You can also check out our lender comparison tool for better understanding. So now, how long do you get to repay the loan? This is called the repayment tenure. It usually ranges from 5 to 15 years. A longer tenure means smaller EMIs but higher the overall interest payment. A shorter tenure means bigger EMIs but less interest in the longer run. So choose wisely. Now coming on to the best part of education loan, that is the moratorium period. This is a grace period where you don't have to start paying the full EMIs. It usually lasts for your course duration plus 6 to 12 months after the graduation. However, the interest keeps adding up during this time. So some students prefer to pay at least the interest during this period to reduce the overall loan burden. While taking an education loan, some lenders require the collateral, which means that you pledge an asset like property or FD as a security. In case if you are unable to repay the loan, the lender can use this collateral to recover the whole amount. For both secured and unsecured loans, you'll usually need a co-applicant also, that is a parent or a guardian who shares the responsibility of repayment. Their financial profile plays a very big role in your loan approval. But hold on, a lot of students forget about the extra charges like the processing fee, which is a small percentage, usually 0.5 to 2% of the loan amount that is charged upfront by the lender to process your application. Along with this, there is also a margin money which is part of your education cost that you need to fund by yourself. For example, if your total cost of study is 40 lakhs and the lender finances 90%, you must arrange the remaining 10% by yourself, which is 4 lakh in this case. But the good part here is most of the NBFCs and the private banks cover almost 100% of the cost of your study. So once your loan is approved, the lender disburses the money either directly to your university or into your account in installments. This is called the disbursement of your education loan. The amount and the timeline depends on your course and the lender. So once your moratorium period is over, you start paying EMIs, that is equated monthly installments, which is a fixed monthly amount covering both the principal as well as the interest amount that you need to pay. And if you want to prepay a part of your education loan before the schedule, you can reduce your interest burden. And if you want to clear the entire loan early, that's called the foreclosure. However, there are no foreclosure charges in case of an education loan, but it can help you save a lot of money in the long run. Now that you have understood the loan terms, the next big question is how do you compare the interest rates and choose the best one? Different lenders offer different interest rates. Banks, NBFCs, and government schemes all have their own interest structures. Public sector banks generally have lower interest rates, specifically for the government bank schemes like the SBI's education loan scheme, and there are other schemes under the Vidya Lakshmi portal. Next are the private banks, which offer competitive rates but may charge higher interest than the public bank. On the other hand, NBFCs provide loans with flexible eligibility but often charge higher interest rates compared to the bank. And the last is the government schemes like Dr. B.R. Ambedkar Interest Subsidy or Padho Pradesh scheme, which may offer benefits to the specific eligible student. While comparing different lenders, don't just look at their interest rates. Do check out their processing fees, repayment flexibility, and the hidden charges. Even a small difference in the interest rate can save you lakhs of rupees over the loan tenure. So now you might be wondering what decides the interest rate that you get. So let's explore the key factors. Your loan's interest rate is not random. It depends on several factors, and lenders usually evaluate these aspects before deciding how much interest to charge. So let's dive in. First is your course and the university. Loans for the STEM courses in the top universities often get lower interest rates because they have higher employability and the earning potential. Courses with uncertain job prospects may attract higher rates. Second is the loan amount and the tenure. A higher loan amount or the longer repayment period may come with a higher interest rate since the lender's risk increases over time. Third is the collateral versus non-collateral loans. Usually the secured loans, that is with collateral, have lower interest rates because the lender has security, whereas the unsecured loans, that is without collateral, have higher interest rates to cover the risk. Fourth is your co-applicant's financial profile. Lenders usually check the CIBIL score and the income of your co-applicant and their ability to repay. A strong financial background can significantly reduce the interest rate. Fifth is the fixed versus floating interest rate. Fixed rates give stability and your EMI remains the same over the period, whereas the floating rates change with the market conditions. In case the interest rates drop, your EMI will also reduce, but if they rise, your EMI also increases. So now how do you ensure that you get the lowest possible interest rate? Let's talk about some smart strategies. First, compare different lenders. Never settle for the first loan offer that you get. Use Epicred's lender comparison tool to check out multiple banks, NBFCs and international lenders all at one place and choose the best interest rate. Second, maintain a good credit score. If you and your co-applicant have a high CIBIL score, lenders see you as a low-risk borrower and may offer a lower interest rate. Third, opt for a collateral loan if possible. If you have a property, FDs or any other asset, pledge them as collateral so that it can significantly reduce your interest rate. Fourth, choose a bank with special concessions. Some public sector banks offer lower interest rate for the female students or for those studying in the top tier universities. So always check for these benefits. Fifth, negotiate with the lender. Instead of spending hours comparing the lenders, Epicred does it for you in seconds. You can compare different banks, NBFCs and international lenders, check their interest rates and apply directly. And if you are eligible for a better loan deal, like if you have strong academic background or a good co-applicant profile, Epicred can negotiate on your behalf to get a lower interest rate and the better terms, and that will save your time and your effort. So by following these steps, you can save lakhs in your interest payments over the years. So to sum it up, education loans can feel complex, but once you understand the terms and compare options, you can borrow with confidence. But here is the thing, interest rates and the loan terms change frequently. The best way to find the lowest interest rate right now is to talk to our expert education loan counselors. You can reach out to them directly. The link is in the description. Don't forget to check out our lender comparison tool. With just a few clicks, you will get the latest data on the interest rates, the loan terms and the eligibility for multiple banks and NBFCs so that you can pick the best option for your study journey. At Epicred, we simplify the education loan process and connect you with 15 plus lenders and ensure complete transparency all at zero cost to you. If you found this video helpful, don't forget to like, share and subscribe. And if you have any questions, drop them in the comment section and we'll be happy to help.